Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Lucid Group.
If you find our talks useful, please consider subscribe, like, and comment underneath. And really quickly before we jump in, a quick shout out to StockOracle. It's an AI-aided stock research platform that we use to help frame these conversations. There's a special 14-day trial link right below in the description.
Yeah, and just as a heads up, it is an affiliate link, meaning the channel may earn a commission at no extra cost to you if you use it.
Exactly. And please remember, StockOracle's AI insights and valuation estimates can be incomplete or just, flat out wrong, so always verify important facts on your own. It is definitely not financial advice, it's not a trading signal service, and it's not real-time market data. So, with all that out of the way, let's get into it. Imagine building this highly advanced premium product that costs you $192 to make, right? And then you just turn around and sell it for $100. Like in almost any normal industry on Earth, your business would be totally bankrupt by Friday.
Oh yeah, you'd be laughed right out of the boardroom.
Right. But in the electric vehicle market, you might just get handed a $4.7 billion check from a literal prince. It's wild. So today we have a massive stack of data on the table, deep fundamental analysis, technical charts, and a slew of recent news catalysts. We're unpacking the incredibly complex, highly polarizing turnaround story of Lucid Group.
It really is one of the most fascinating puzzles in the market right now, especially when you think about wealth-building context.
Yeah.
I mean, you are looking at a company that is burning cash at a historic rate.
Yeah, it's staggering.
Right, and this is during a time when the broader EV sector is undergoing this brutal, unforgiving shakeout. Yet, as you mentioned, some of the deepest pockets on the planet are eagerly handing them more money. It's honestly a masterclass in how shifting narratives and sovereign wealth backing can completely warp traditional market rules.
I want to start by looking at the raw fundamentals because the financial reality they are currently living in is just full of contradictions. I was looking at their top-line revenue, and the growth is actually pretty staggering.
It is.
They are up 61.03% trailing 12 months year over year. Like they're ramping up deliveries of the Air, they're rolling out the initial phases of the Gravity SUV. So on the surface, people are actually buying the cars.
The demand is there. Accelerating your revenue by 61% over a trailing 12-month period is a really clear signal that the product itself has market fit. I mean, they are moving metal.
But then I flipped over to the profitability metrics, and honestly, I thought the page was broken. It is a complete bloodbath.
Oh, it is severe. Just to put the exact numbers on it for you, their earnings per share sits at negative $10.55.
Wow.
Yeah. The net margin is negative 239.81%. And the one that usually causes retail investors to just, slam their laptop shut is the gross margin, which is currently negative 92.46%.
Okay, we have to unpack this because that negative 92% gross margin is exactly what I was talking about at the beginning. You are selling a car for significantly less than it costs to physically produce it.
Right.
Explain to me how this isn't just a massive money-burning furnace. Like, how does any company survive those kinds of unit economics?
Well, what's fascinating here is that you have to understand the underlying mechanics of early-stage automotive gigafactories.
Yep.
It really comes down to separating variable costs from fixed costs.
Break that down for me.
Think of it like renting a massive state-of-the-art commercial bakery to bake a single cupcake.
Okay.
Because of the rent, the heavy equipment, the staff required just to turn the lights on, that one cupcake technically costs you $10,000 to make.
Right, because the bakery's so expensive to run.
Exactly. The bakery is a fixed cost. But once you ramp up operations and you're baking 50,000 cupcakes a day, the cost of the bakery divided by the number of cupcakes drops to just pennies.
Oh, I see.
Yeah, automotive manufacturing works the exact same way. Lucid has built this billion-dollar infrastructure. Those massive fixed costs just haven't been absorbed by scale yet because the vehicle volume is still too low.
So mathematically, every car rolling off the line right now represents a massive loss. But that loss isn't a permanent flaw in the car's design. It's just a symptom of their current factory output.
Precisely. And this is why analysts tracking the stock are looking past the current burn rate. A lot of them are still citing a fair value estimate of around $8.40 per share.
Gotcha. So the bullish thesis is just relying on the mechanics of scale.
Yeah, the expectation that long-term revenue growth will eventually absorb those fixed costs, which leads to massive margin repair.
But to even reach that point where the margins flip, you need an absurd amount of time. And time, in this industry, means cash. If you are losing that much money per vehicle, you need a massive safety net just to keep the lights on until you reach scale.
And that safety net is the foundational pillar of the entire bull case for Lucid. Right now, they are sitting on $4.7 billion in liquidity.
Which is a staggering amount of cash for a company that looks so distressed on paper. I noticed in the fundamental data that their price-to-book ratio is sitting at 1.4131. What does that actually signal to us?
Well, price-to-book ratio basically compares the market's valuation of the company to actual tangible assets it owns, like the cash in the factories.
Right.
A ratio of 1.4131 suggests the market is valuing their hard assets and that massive cash pile at a reasonable premium. They aren't pricing it like a company teetering on the edge of immediate bankruptcy.
So that $4.7 billion gives them a real lifeline.
Oh, yeah. It came from a recent capital raise and credit expansion, and it gives them a runway that extends deep into 2027.
So they aren't in imminent danger of the factory doors being padlocked.
No. I mean, free cash flow is negative, absolutely, but it's not being wasted. It is being directly reinvested into capacity and economy development. That cash buffer lets them fund the heavy capital expenditures required to bring new models to market without the immediate threat of running out of oxygen.
But even a $4.7 billion war chest won't last forever if you're just selling luxury sedans one at a time to early adopters in California. To outrun a burn rate this massive, they have to entirely change who they sell to.
Right. They need a fundamental paradigm shift in volume.
And this is where the catalysts really highlight their massive B2B pivot, business to business. They aren't just relying on consumer retail anymore. They are leaning heavily into corporate fleet partnerships. Because from what I'm reading, under the hood, Lucid's real technological moat isn't the luxury leather seats, it's their proprietary powertrain and battery pack technology.
It is class leading in terms of range and efficiency.
And that specific tech edge has landed them a massively deepened relationship with Uber. Uber has invested a total of $500 million into Lucid, committing to purchase up to 35,000 vehicles to power its own robotaxi division. I mean, 35,000 vehicles.
It's huge.
Yeah. They aren't just trying to sell you a luxury car anymore. They're trying to become the engine room for the entire autonomous fleet industry.
And if we connect this to the bigger picture, a 35,000 vehicle commitment is not just a temporary sales bump. That is a foundational shift in their manufacturing baseload.
How so?
Well, when you are selling cars directly to consumers, demand is unpredictable. It fluctuates with interest rates, consumer sentiment, macroeconomics. But B2B sales provide something the consumer market rarely does, which is a predictable contractual revenue stream.
Because they know exactly how many cars Uber needs over a set timeline.
Yes. And going back to our commercial bakery analogy, when you know exactly how much product you need to output over the next 3 years, you can optimize your factory line. You can finally absorb those fixed costs.
And the Uber deal isn't an isolated incident. There is a newly announced partnership with Nuro, an autonomous vehicle company. This includes a planned $300 million investment from Uber, committing to deploy at least 20,000 Lucid Gravity vehicles as robotaxis over the next 6 years.
Which fundamentally shifts the company's risk profile. They're transitioning from a speculative consumer brand to a foundational infrastructure provider. Furthermore, getting your powertrains into tens of thousands of commercial fleet vehicles, that opens up incredibly lucrative, high-margin technology licensing opportunities down the road.
But I'm also trying to capture more of the everyday consumer market at the same time, right? They're pushing out sub-$50,000 models, and they just confirmed participation in California's My First EV program, which puts a $3,000 discount on those cheaper models.
They are attacking both fronts, yes, but the fleet contracts are what guarantee the factory keeps humming at a baseline volume.
Okay, so you have the proprietary tech, and you have these massive fleet contracts securing the volume you need to reach scale. But turning a contract into physical metal on a factory floor requires endless capital. Securing tens of thousands of robotaxis is incredibly expensive. Which brings us to sentiment. And who is actually financing this ambitious pivot behind the scenes?
Right.
Because there are some massive players circling the waters here.
The institutional and sovereign backing here is almost unprecedented for a company with margins this negative.
So on July 23, 2026, this bombshell 13G filing hits the wire. Now, real quick, for anyone who doesn't track SEC forms, a 13G filing is what an investor has to submit when they acquire more than 5% of a company's stock.
It's a huge deal.
Yeah, it's a massive signal to the market. And in this case, the filing revealed that Prince Alwaleed bin Talal has taken a 5% ownership stake. We were talking 19.5 million shares.
And when you see a 13G from someone like Prince Alwaleed, who is one of the most prominent billionaire investors in the world, it acts as a massive beacon of social and financial validation for the stock.
And he's joining the existing financial bedrock of the company, which is Saudi Arabia's Public Investment Fund, or the PIF. They already own the majority of the voting shares. But it's not just the sovereign wealth and the literal royals. The sentiment data shows that over the last 90 days, there has been a wave of net insider buying to the tune of 282,575 shares.
Wow.
Yeah, that's spread across 11 buy transactions versus only 6 sells. If you're looking at this from the outside, trying to make sense of your portfolio, what are these insiders and billionaires seeing that the average retail investor is missing?
Well, this really highlights the incredible gap between market psychology and internal visibility. The average retail investor looks at a negative 92.46% gross margin and panics. They see a cash-burning machine and they sell.
Naturally.
Right. But the insiders, the board members, the sovereign wealth funds, they have visibility into the factory floor. They can physically see the improvements. They can see the ink drying on the Uber and Neuro contracts, and they can see the technology licensing agreements taking shape in real time.
So they are buying based on future capacity, not current reality.
Exactly. This kind of heavy institutional and insider cluster buying stabilizes the shareholder base. When the people who know the most about the company are buying the stock while it's down, it shifts the overall market mood from hopelessly bearish to cautiously bullish. In fact, platforms like Simply Walson are noting the stock might actually be around 12.1% undervalued at current levels based on the projection of those future cash flows.
It's the ultimate contrarian play, right? Smart money moving in when there's blood in the water.
But I think we need a reality check here on the technicals. It's easy to get swept up in the narrative of royal backing and massive robotaxi fleets. Let's look at the actual scoreboard. What is the stock price physically doing on the open market? And what are the very real risks still lurking in the shadows?
We have to, because despite this compelling, forward-looking narrative, the technical realities on the chart have been absolutely grueling for anyone holding this stock long term. Yeah, right now the stock is trading at $7.38. It's actually down 9.11% just today, though it is managing to hold above a critical support level. But when you zoom out, the 52-week drop is just breathtaking. It is down 70% from its highs of $25.30.
A 70% drawdown will test the conviction of any investor. It doesn't matter if you have a sovereign wealth fund backing you, staring at a chart that has lost over 2/3 of its value is psychologically punishing.
But there is a glimmer of a turnaround on the technicals. The intermediate term reversal is flashing green. It's up 28.125% over the last 13 weeks, rebounding sharply from a terrifying 52-week low of just $2.37.
That's a solid bounce.
Yeah, and the volume is steady, so it doesn't look like just a speculative overnight blow off top. But we have to talk about the bear case and the risks. As much as the bulls love to point to the Saudi backing and the $4.7 billion in cash, there are massive risks here. Execution risk on the Saudi production ramp is huge. If they fumble the manufacturing quality or the timelines, that cash burn will accelerate.
Absolutely.
But let me play devil's advocate here on the biggest risk of all. Having a sovereign wealth fund as your primary backer sounds great, but if the Saudi PIF owns the majority of the voting shares, couldn't they just force a funding round whenever they want that dilutes everyday minority shareholders into oblivion?
That is the ultimate double-edged sword of sovereign wealth backing, and you have hit on the single biggest fear for retail investors. The PIF essentially dictates Lucid's future. If Lucid needs more money, the PIF has deep enough pockets to write the check. But the terms of that capital injection do not have to be friendly to you or any other retail shareholder. If they issue millions of new shares to raise that capital, and you don't have the funds to buy in and maintain your percentage of ownership, your slice of the pie gets significantly smaller.
Your shares get diluted down to a fraction of their previous value.
Exactly. That dilution risk is a persistent, heavy overhang on the stock. It scares away a lot of traditional institutional investors who don't want to be at the mercy of a single, massive, controlling entity. However, and this is a crucial caveat, that recent $4.7 billion liquidity raise provides a massive window of safety.
Because they don't need to go back to the well for more money anytime soon.
Right. It pushes the timeline for any mandatory, potentially dilutive capital event deep into 2027. It delays that immediate threat. It gives the company the breathing room to let the Uber and Neuro contracts actually start generating cash and proving the business model before they are forced to raise capital under duress.
So they have this window, this buffer of time, but at some point the market demands proof. When do these theories actually get tested?
The clock is ticking, and Wall Street is incredibly impatient. They want to see proof of life soon.
And the big red circle on the calendar is August 4th, 2026. That is when Lucid reports their Q2 2026 earnings after the bell. And it's not just about the raw revenue numbers. The market is watching for three very specific things. First, the Gravity SUV production ramp. Like, are they hitting their manufacturing targets? Second, concrete updates on those two affordable mid-size models. And third, and arguably most importantly, specific hard guidance on those robo-taxi deployment timelines.
Any strong guidance on their self-driving technology roadmap is going to be the absolute key. If they can prove that the technology is ready for prime time, it opens the floodgates for sales to fleet operators outside of just Uber and Neuro.
Plus, they have some macro tailwinds right now that could help that earnings report. High gas prices historically drive consumers toward EV sales across the board. And that $3,000 California My First EV discount is going to directly benefit the rollout of their sub-$50,000 models in a massive market.
It's a perfect storm of catalysts.
Yeah. So when you synthesize all of this, the brutal technicals, the improving fundamentals, the upcoming catalyst, the current investment thesis gives this a bullish score of 7 out of 10. The setup looks like a swing trade into the August 4 earnings, with the potential to evolve into a multi-year hold if they actually confirm that their margins are repairing. So what does this actually mean for your portfolio if you're tracking this stock? Can you give us the final verdict on this complex narrative?
The synthesized takeaway is this. The market may be severely mispricing the reality of this operational turnaround. You have a company trading 70% off its all-time highs. But beneath that beaten-down stock price, it has a fortified balance sheet with $4.7 billion in liquidity. You have heavy insider cluster buying, a new 5% billionaire stakeholder in Prince Alwaleed, and a massive B2B fleet opportunity that completely rewrites their revenue model.
So the retail market sees the negative 92.46% gross margin and runs for the hills. But the institutional market sees a fully funded bridge to scale.
Exactly. If they hit their execution marks on the Gravity ramp and the robo-taxi deliveries, the fixed costs of that factory will get absorbed, the margins will flip, and the current valuation will look like a historic anomaly in hindsight. But the execution has to be flawless.
It is a high-stakes race between a terrifying cash burn on one side and a brilliantly funded, technologically superior robotaxi pivot on the other. They have the money, they have the tech, and they have a royal backing. Now they just have to physically build the cars without burning the house down.
And that leads to a really provocative thought to lead you with based on where all these data points are pointing. We've spent this entire time evaluating Lucid as a traditional car company trying to survive in a crowded consumer market. But consider this. If the Uber and Neuro partnerships succeed, and their proprietary battery and powertrain tech proves to be the absolute gold standard for efficiency and range, what if Lucid's endgame isn't to be a consumer car brand at all?
What do you mean?
What if their ultimate destiny is simply to be the underlying licensed technology that runs the world's commercial autonomous fleets? They don't need to sell you a sedan. They just need every robo-taxi on Earth to be built on a Lucid chassis.
Wow. From trying to sell luxury sedans to individual buyers to powering the entire global grid of robotaxis, that completely changes how you look at the fundamental metrics we started with. If they pull that off, they aren't failing at building a traditional car company. They're just building a completely different kind of empire.
Exactly.
Well, as always, keep questioning the consensus, keep looking past the surface numbers, and keep digging into the mechanics behind the headlines. And hey, if you want to run your own analysis, don't forget to check out the special 14-day trial link for StockOracle in the description below.
Yeah, it's a great tool for AI-aided insights, but again, always verify the data yourself. And if you enjoyed today's discussion, please subscribe, like, and leave a comment down below.
Thanks for joining us for today's talk, and we'll catch you next time.